This is not end of cycle market behavior. This is early cycle expansion reaccelerating.
What if it's just a late year, run as fast as you can, catch up to what you missed? A lot of money has come in and it's just chasing everything to the end of the year as rates have come down.
We've seen a huge turnaround in cyclical stocks. The banks are turning, the regional banks are turning up, small caps are leading. I think if this is 98, we can run another 7% from today.
To when?
To year end. 4,800 is more reasonable. But I think that if it was a head fake, we'd see credit calling baloney and we'd see spreads widen or high yield falling. But what's happened is spreads have rallied, high yields rallied. It's actually a improving liquidity rally while investors took $240 billion out of stocks this year. Now, as we get into next year, we'll have an FOMC decision. I think it's going to show the Fed is no longer fighting an inflation war, but really shifting towards managing the business cycle. Huge change. Interest rates could make a huge move lower. Our technician thinks it could be 3.5%, 3.2. And that would take mortgage rates down to 5 or under 5%. We know that would help the economy. And I think there's a lot of pent-up demand for CapEx. Stocks could do very well next year.
Why do you think things have gone right for you, investors and bulls, for the most part, especially lately?
Economists were too bearish, and the technical picture turned positive very quickly. I think people were fooled by the yield curve at the start of this year, thinking we'd have a hard landing, and they didn't want to fight a Fed, but they're forgetting the Fed was fighting an inflation war, not a business cycle. So our bet was inflation would be softer, you'd avoid a hard landing, and then we've seen the Fed kind of take its foot off the neck of monetary policies.
I hear bears say earnings aren't going to be as good because inflation is not going to be as good for earnings, and that's going to be a negative, and that's why the market's overvalued, and people like you at $260 are just way too optimistic on where earnings are going to be.
Well, I think people should study the PPI. Like 4 or 5 sectors are correlated to PPI, like materials, energy, meaning is inflation falls, they make less money, but tech and industrials have almost no correlation to inflation. And then financials are positively correlated. So I think you have more groups that could actually have better earnings power into next year. And especially if caution comes off companies, CapEx, there's a lot of pent-up demand in CapEx. 5 out of 10 groups actually sort of cut CapEx as a percentage of revenues last year. So you have a CapEx opportunity, you have a home recovery opportunity, and you have interest rates falling. It's hard to say stocks should fall next year.
Your target for 2024 S&P is 5,200.
Yes.
What gets us there?
Well, it's earnings recovery. So we think earnings hit 265 by 2025. That's 2 years of like 9% growth. And you put a 20 PE. 20 PE has happened 50% of the time when the 10 years between 4 and 5%. So it's the most common PE to apply, and that would be 5,200.
How much do you need cash to come in from money markets that's been sitting in safety, and now it goes towards risk assets because rates have come down and you get better yield out of the equity market?
This year, if someone bought FANG, they'd be up to 85%. That's 15 years of money market cash. If they buy small caps next year and small caps are at 50, that's 10 years. So I do think that $240 billion that left is coming back in. But hedge funds also have very light positioning in equities. I mean, I don't know if you saw that there's almost a 5-year low in hedge fund positioning in financials, and financials really should be where things turn next year.
The market thinks the Fed's going to cut first in March.
That seems aggressive, but what's going to matter more is what the bond market starts to price. And I think the 2-year is telling us the Fed does have to cut meaningfully next year, because if they don't cut and inflation weakens, the level of real Fed funds is associated with a hard landing. Like the Fed, if they're trying to manage the business cycle, would be cutting rates.
Do you need the Fed to be somewhat aggressive in cutting to get to your 5,200?
We just need the market to get comfortable with 2 things: that the curve can stay inverted, meaning the 10-year could actually go to 2.5 and the Fed's still at 4. And the second is that stocks and bonds don't have to be positively correlated. So yields could go up and stocks could rise. I think that there's some protection or buffer against if the Fed doesn't cut rate.
What about small caps? There's still a lot of non-believers.
We've had 12 years of underperformance. The price to book of small caps to the large caps is exactly where it was in 99, which was the start of a 12-year bull run. Banks are a huge weight in small caps. We know falling rates helps asset quality, so regional banks should rally. That should pull up small caps. It's clearly under-owned and they benefit from inflows. And then, of course, I think large cap banks are really good plays on a CapEx cycle. So to me, it's easy to see that 20-30% kind of moves in those groups small caps maybe 50, whereas it's harder to say FANG can do 50 next year.
Despite revealing your target at 5,200, mega caps, tech, not going to lead next year.
That's right. I think the earnings growth they produce doesn't look as special if the PMIs are turning up. If the ISM turns up, S&P earnings going to grow, 15, 20%. And then on terms of multiple expansion, I think people are going to be more willing to fade a FANG multiple expansion, whereas they'll buy a financials multiple expansion.
So you think there's going to be a rotation out of mega cap into some of these quote unquote unloved areas?
Yes, FANG is still a number 3 pick, which means it outperforms. But if someone's saying where will they get the best risk reward, I think it's clearly financials or industrial. Let's say S&P's up 12 to 15 next year. FANG will be maybe a little bit better, whereas financials probably can be up 30, and industrials can be up 25, and small caps can be up 50.